Alright, so this next video lesson is T6 weekly hot sauce trade, and what I am going to share about this particular setup right from the beginning, I want to emphasize as strongly as I possibly can. This is referred to as a hot sauce trade for a reason. Hot sauce burns your mouth if it's too hot, and the potential for this to be really dangerous is there because it does react and perform very nicely. However, it is a high gamma risk trade because we are buying and selling options that are very close to expiration. Okay, so this is something that I believe should be added much farther down the line after you've worked through all the other setups and all the other strategy lessons, and then you can discover and see if you even want to add this into your repertoire of trading. But this is the setup, okay? I just want to put that disclaimer and emphasize that as strongly as I know how at the beginning, because this definitely has the potential to be a nice winning trade, and it also has the potential to be very damaging to your account. All right, so as I have been saying all along, you backtest the strategy, you paper trade the strategy, you get consistently profitable with it in demo environment for several cycles, several months, and then you slowly transition it into live if you feel confident in it. All right, but this is the setup. So it's using the SPY. You can graduate that to any underlying asset you prefer. I like to stay in the SPY. Capital allocation is approximately $300 per contract. You're entering these anywhere from 9 to 24 days to expiration. The varying days to expiration will react differently, and if we look at the setup on that, you'll see you've got 10 days to expiration here, 17 days to expiration here, 24. Always opening them on a Wednesday will give you plenty of choices to select from. Okay, so let's say what the strike selection is. We are selling one iron butterfly or iron condor with the short strikes right at the money or separated by one strike only. Upper wing is 4 points higher, lower wing is 7 points lower. You can experiment with those wing widths, but essentially let's look at 17 days to expiration. If the SPY is at 234, I will say I will come right here and I will sell one. I will go 1, 2, 3, 4, 5, 6, 7. I will buy one. That's my 7-point wing width. And actually, let me. Oh, this is what I wanted to bring up a little bit higher so we can see that better. All right, so we've got 7-point swings here. Then we come on the call side, -1, 1, 2, 3, 4. All right, so we're just following these guidelines to get us started. So we've got a 7x4 unbalanced. All right, it starts out with T plus 0 line relatively flat, but look at the slope of that angle. You can see it drops off very quickly, but these are very short duration trades. There is no adjusting either to the upside or the downside, and we are only targeting specific amounts. We're not watching this trade or trying to protect profits. This is an open and close type setup. All right, especially if it ranges for very lengthy periods of time. The opportunity, the ability to say, well, this is a $400 trade right here for margin, has a potential to return 240. If I'm targeting 5% of that, that's $20. It's very, very small amounts because we're in these every week, week in, week out. Okay, so 5% of margin is a target profit. 10% of margin is a target profit only after you've had 3 consecutive winning trades. And the reason for that is because then you are building a little bit of cushion so that if or when you take that max loss trade, you're not immediately going underwater. So you're targeting 5%. If you get 3 consecutive winning trades, then you can hold out on target a little bit longer. All right. As far as the trade closure, it's either at 10% of margin, so maximum loss, or immediate exit at the expiration break even on either side. All right, so that's the setup right here, and this is a very simple trade to put on and take off week in, week out, and you'll have the opportunity to use the good till canceled contingent orders on the platform to say, all right, if this is a trade setup, and we'll just we'll convert that right there. You'll say that here's the setup. I am going to close this at either 10% down or this point or at this point. All right, and so if I show the break evens at expiration, well, right there at 232.31 or 237.69, the trade is gone. So at that point, this trade would be down $56, which is a little bit over 10% of margin. On this side, it's $40. And so you'll notice that when we put this on, we're relatively delta neutral at inception. We are heavily theta positive. We are heavily vega negative. And we just walk it through. We walk it through a day at a time, and we see if the market moves one direction or the other, and you'll notice that it didn't move much, and now we're building a little bit of cushion in. Expiration break even, now we're at 49. Now we're at 36. All right, we'll go another day. And this is intended to be, and this was created and designed to kind of augment the core income and growth trades, but it should be viewed as a speculative or a very small percentage of your trading activity, if you even decide you want to pursue this. All right, so there you go. You'll see now we're up $18. 5% of the margin is $20, so we're almost there. And we can say, all right, well, it hasn't moved that much for 2 days. We hold it over the weekend, and what happened at the Monday? We moved up 1.5 points. Have we hit the expiration break even at 237? No. Have we hit our target profit? No. Have we hit our maximum loss? No. Nothing to do. So again, then we just roll forward to the next day. This is a very simple trade to put on and take off, and you never have to monitor and watch it. Now you can monitor and you can watch it, but now you'll see we've been in this trade for 1 week, 8 days, and we'll probably have opened a second trade in a different expiration cycle as these become available, or as these become available. So the thinking is you do this on a weekly basis, week in, week out. You'll see we've now hit target profit on this one, so we would close a trade, or you wait until the next day. I would say close a trade. You've hit target profit, you close a trade, you keep those profits. You wait one more day. Yes, you can make more. Yes, you can lose more. It can move very quickly. But you'll see then that we go back here. The commission load is what will be the biggest detriment to this trade, but we'll go ahead and convert trades. So now that one's done. So then we'll go, it's Wednesday, maybe we want to go out to 24 days to expiration. And we're at 236. Maybe I want to separate the strikes. So I'll go one, sell one here at 235, 2, 3, 4, 5, 6, 7, buy one here, 235. I can go to 236, or I can even go to 237. 1, 2, 3, 4. All right. And then this is the profile. So now that's separated by 2 strikes because I went, out one on both sides, or if I stayed right there, it's only separated by 1, but we've got the shorts that are under. The parameters do not change. Expiration break even is the cutout and close point, expiration break even is the cutout and close point. Or target profit, 5% of margin, so 5% of $390, or maximum loss, 10% of margin. So we'll just convert that. Let's go in here and we'll say this was A and this was B. Now we'll move a day in the future and we'll see if this is moved towards our expiration break even or if it's moved to our take profit or max loss. And it's really done nothing, so we go to another day. And you know, the idea is this is a fast moving trade that either hits target or it hits loss, and it can be viewed as a way to stay active, so you resist the urge and the tendency that most traders possess of micromanaging the core income larger trades. So now here we are, we've moved $3.31. We are past our expiration break even, so this trade would have already closed by the good till canceled orders, and so this trade would be a loss. All right, so we clear that, convert that. We can reopen it in this exact same cycle. We can come closer. Well, let's just come closer and see what that one does. Okay, so that's that portion, and then we'll go here. All right, so this is a little bit more expensive because you're getting closer to expiration. All right, but look at the how this slope changes so much quicker, where we have 10 days to expiration. We hit the expiration break even. We'll be down $86. We'll be down $38. So again, it's just it's a trade-off, and it's a question you have to ask yourself. If this is a trade that you even want to pursue, and I would seriously consider waiting until you are much more proficient and comfortable with these other ones that are much more, I don't want to say they're safer. They're absolutely safer. They're not as volatile. That's a good word. They're not as turbulent as this particular trade. This one does have a lot of potential to be very damaging, but it does have that positive expectancy to it when you manage it according to the guidelines. Feel free to adjust and make those unique to yourself, but this is a good starting point to say, all right, now I came in right closer to the money. I had much more rapid theta decay, and I hit target profit. All right, so I've had 2 winners and 1 loser right there. And so let's just close this, convert trade log, and that is trade C. Well, that was B, was here, and this is C. There we go. All right, so then you'll be able to see, if you go to the report menu, you can see we've had a $17 winner, a $21 loser, a $26 winner, and we'll just keep rolling forward. Now this trade is closed. There's nothing to do until the following Wednesday. So it's a very methodical way to say, I'm going to play in the weeklies. I'm going to execute weekly trades, week in, week out. I'm going to say, here's one. That's 7. And let's just say that instead of 4, I want to do 5. All right, so I'll go 7 by 5. See what the difference is? It doesn't change it much. It puts more risk to the upside, but it still starts out. You're utilizing the expiration break evens 233 to 239 as your cutout point. So you're down 78, you're down 84 on a $437 trade. Now that's more than 10% of margin, so that is where your contingent conditional order to close this trade will kick in. All right, so that's number D, or letter D. And we'll just move forward a day. We'll see if we hit our $20 target profit or our $40 maximum loss. And I think that after spending some time testing this and monitoring it and trading it in backtester environment, in paper money, in simulated environment, you will quickly learn if it's even something you want to pursue or not. All right. So now what we've got target profit hit, close the trade. And again, it's got to be a condition to where you honor your rules and you say, all right, now I'm out of this trade for a couple more days, and there is no reason why you couldn't come to a little bit farther than the 24 days. I just specifically selected the 9 to 24 days because it would give you those 3 expiration cycles to pick from. You could pick the 10-day, you could pick the 17-day, you could pick the 24-day. There is nothing wrong with coming out here into the 30-day and say, well, let me go right here, and then I can go right here. All right, it gives you the same profile, the same setup, the same structure. You just have longer days in this trade. The management and the conditional orders do not change. It's all managed and transacted the exact same way. All right, so I'll finish up this one here, and I think you kind of get the idea. It's a simple, straightforward way of playing in the weeklies, and now see, we have almost hit target profit in 1 day. So these rapidly decay. Obviously, it's gonna react in low volatility different than high volatility. If you get a hard directional move, you cannot get married or committed to this. This is not an adjustable trade. It's an open and closed type trade. It's either going to hit your target profit or it's going to hit your maximum loss, and that's it. Period. End of story. So this one would close, convert trades, and you'll see. So just in the few short minutes here, we've got $78 in 5 trades in 5 weeks, and we've never really had more than about $300 or $500 at risk. So we'll say that we'll use 500 for simple math, and we'll say $78 returned on $500 of margin. That's a 15% return on margin in 5 weeks, and that even accounts for the loser. So now we can say, well, what if I wanted to make this next one, I want to target a little bit higher amount. The parameters do not change. We still say -1. We'll go 234 here. All right, so setup is still the same, and we convert to trade log, and this will be letter F. So now, instead of targeting the 5%, we're going to target 10%. We've had 3 consecutive winners. We're still going to have our 10% maximum loss rule, or if the expiration break even gets tagged. And that's the simple long and short of it. It's not that complicated, but it does hold a incredible amount of potential to be dangerous. We have a very high gamma impact, so we want to be very mindful and be very respectful of that. So here we go. We're up well over 10%. We're up $46. We're not at an expiration break even, so you have choices. As you have options. You always have options, and you can say, well, I'm not going to close it. I will wait until I hit this expiration break even right here, because then I know I'm at least going to lock in a $23 profit. Here it would be a $21 loss if it happened this same day. Let's move to the next day, because we're getting ready to open up the next cycle because it's the following Wednesday. So we went from $46 to $49. So we're starting to slope off. We're going to give up those profits. If it falls back, we will realize more, or if we stay in it for another 7 days, you'll see you'll target even higher amounts. I would not get in the habit of trying to target thinking it's going to stay under this tent for you. Once you hit your target profit, close the trade, because I mean, very often it's going to move outside of that tent because the market will move very rapidly and very quickly. A handful of times a year it might stay in the tent for a week or two and allow you to capture a 20 or 30 or 40% return on margin for that one specific trade. But the danger is in the process for waiting those handful of times a year that it happens. You're going to have many, many more times of the year that your 10% return on margin, you give it up because it goes right here. We're saying I'm willing to risk capturing a full $80 to let it slide all the way back to $30. It's not the ideal set of circumstances, in my opinion, because you've got the ability to trade these once a week. You can trade these every day in different expiration cycles if you have the time to manage it and do it, or the desire. Okay, so I'll just kind of close on that note, because I think this is one of those trades to where we see that it's an open and close type setup. It can be done on a weekly basis, a monthly basis, a daily basis, every 3-day basis, a Monday, Thursday basis, whatever the scenario that you desire. I like to put these on Wednesday and then close them off before the following Wednesday, or at target profit, max loss, or expiration break even. Okay, so that's the T6 trade setup that you now have access to, and feel free to experiment with making changes to it, but this is a good core set of guidelines to get you started on this weekly hot sauce trade. All right, thanks.